This video, I would like to highlight how to optimize your stock portfolio for maximum return. You want to achieve maximum returns in your stocks investment. So, how do you go about optimizing your portfolio to be able to achieve that level of returns? And so, managing your portfolio for maximum return involve a combination of strategic planning, regular monitoring, and discipline when it comes to execution. And so, here are what you could do to be able to obtain, a maximized level of returns in your stock portfolio. Number one is set clear financial goals. You have to take your time and ensure that your goals are very, very clear. Your aims and objectives are well spelled out. So define your investment objectives, such as retirement savings, wealth accumulation, or generating passive income whatsoever. So determine your time horizon as well as some risk tolerance, which will guide your asset allocation and stock selection. Once your aims and objectives are very clear, your goals are well defined, then this will guide you on the kind of stocks you are going to select, and other factors you're going to consider to make sure that you have and optimize returns at the end of the day. Number two is diversify your portfolio. Diversify your portfolio. So spread investments across sectors, across industries, and even geographic regions to reduce risk. Consider including a mixture of large cap, mid cap, small cap to balance stability and growth potentials in your portfolio. You have to bring in, mega cap stocks. You may need to bring in large cap stocks. You may equally need to incorporate small caps, mid caps, into your investment mix so as to be able to have a smoother level of returns, in the market. Number three is regularly rebalance your portfolio. Rebalance your portfolio, on a regular basis. So periodically review your portfolio to ensure it aligns with your target assets allocation. Rebalance by selling overperforming stocks or assets and buying more of underperforming ones to maintain your desired risk level. Usually, when a portfolio is doing very, very well and probably had reached its peak and it's getting overvalued, it's getting more expensive, you can sell that stock and buy the ones that are still cheap, that are on their way up. That's how you obtain optimal balance in your portfolio. Number four is stay informed and educated. Stay informed and educated. I can't overemphasize the fact that you need to be highly informed and highly educated, knowledgeable as an investor. That will eventually affect your portfolio and invariably will equally influence the kind of returns you'll obtain at the end of it all. So keep up with market news, economic indicators, and changes in company fundamentals. Continually expand your knowledge of investing strategies, tools, and market trend. You have a whole toolbox you could deploy when it comes to investing. You equally need to monitor and understand market trends, and as well as adopt the kind of strategies that will help you to be able to maximize your returns at the end of it. Or not only that, you look into company fundamentals and see how each company does when it comes to its fundamental performance, because that will eventually influence the earnings of the company, and the earnings will then equally at the end of the day impact the level of the kind of stock price you will see at the end of the day. Number five is Monitor company performance. Monitor company performance. Regularly review the financial health and performance of the companies in your portfolio. Watch for red flags such as declining revenue, increasing debts, or changes in leadership that could impact stock values. Whenever a company is recording declining revenue or sales or turnover, that is an outstanding red flag. Whenever there's increase in debt, the company keeps on increasing debt, and then that will equally affect the company at the end of the day. When it's a change in leadership, sometimes, a company may bring in kind of inept, inefficient leadership that will equally influence the company performance at the end of the day. So all these factors are worth considering as an investor. Number 6 is avoid emotional decisions. Stay disciplined and avoid making impulsive decisions based on market volatility or media hype. When it comes to investing, just keep calm. All right, keep calm. Don't be influenced by fad, by trend, by sentiments, by fear, or by greed. No, be influenced by logic, by reason, and allow companies' fundamentals to determine your investment, decisions. Don't allow externalities to influence what you do. No, be immune, kind of. Be impervious to what is happening around you. Simply focus on the company fundamentals, but that will determine the performance of the stocks in the long run, not by all these external factors. So don't allow them to affect your decisions. Number 7 is use dollar cost averaging. Dollar cost averaging. So invest a fixed amount of money at regular intervals, regularly, regardless of market conditions, to reduce the impact of volatility and lower your average purchase price over time. Just make up your mind that, okay, every one month or every two months or quarterly, I'm going to put a certain amount of money in the market and maintain that level of discipline. Whether the stock prices are high, you don't bother. Whether the prices are coming down, you don't really bother. Keep on buying. As company prices are going on, you buy. When they're coming down, you buy. At the end of the day, you will accumulate. You have a net. You will accumulate your stocks, at the price that is considered, lower than what it will have been. Assuming you don't really have this particular discipline, inbuilt into your process. Please like this video and subscribe to this channel. Don't forget to, ring the notification bell. Number 8, optimize for tax efficiency. Optimize for tax efficiency. Take tax advantages into consideration. You may operate accounts like IRS and 401k to minimize tax liabilities on investment gains. Implement strategies like tax loss harvesting to offset gains with losses and reduce your overall tax burden. Usually, when you sell at a loss, you have a lesser tax burden on you. When you sell at a gain, you have a higher tax burden on you, and that's why capital gain tax you have to take into consideration, because generally when you sell the investment within a short period of time and you obtain a gain on that particular sales, that gain will be taxed at a higher rate compared to if you held the stock for a long time before you sell. So all these things are what you consider when it comes to taxes and how it influences your investment or your returns at the end of the day. So monitor tax very well so as to be able to maximize your returns at the end of it. Or number 9 is consider dividend reinvestment. Consider dividend and reinvestment. Reinvest dividends to purchase more shares of stocks, which can compound your return over time. Choose companies with a strong history of dividends growth to enhance your income potential. Generally, when it comes to investing, I would advise, if you're the type that's inclined towards dividends, buy those stocks they call dividend aristocrats. They keep on paying dividends year in, year out, and they do even increase their dividend payout. They equally increase their payout ratio. So you invest on those stocks. And not only that, when the dividend comes in, all right, it's equally advisable you automate the entire process, that as you are collecting your dividends, you are reinvesting it in your portfolio. You don't just consume your dividend, but rather, whatever dividend comes in, you could reinvest it for greater returns, over time. And number 10, review and adjust your strategy. Review and adjust your strategies. And regularly, evaluate your investment strategy and make adjustments based on changes in your financial situation, market condition, and of course, your investments goals or objectives. Be flexible and willing to shift your approach if needed to optimize return. Don't be rigid. Don't say, well, here I stand. Come what may, I will not shift ground. No, be flexible depending on market conditions and depending on company performance. And that flexibility will help you to ride out, negative events in the market and to take advantage from positive, events in the market. And so by consistently applying these principles, you can effectively manage your stock portfolios and maximize your potential returns over time. And so I've stated about 10, factors here. So consider them, implement them, and then you see, a better returns at the end of the day.